Unearned revenues. This concept exists in our FAR, in our FASB, in our GAAP, because we have, say it with me, accrual-based accounting. Accrual-based accounting creates unearned revenues. Now, in cash basis, you receive the cash, and that's revenue. When it's recognized when it's received, this is recognized when it's earned. So unearned revenues are liabilities and represent receipt of cash before the customer has received their goods or service. So you received the cash, but you didn't fulfill your end of the bargain. So you need to complete that. Well, what do you debit and credit when you receive the cash? Well, you are debiting cash. Like, I always start with cash. In any journal entry, is cash changing hands? It's just the most straightforward, easiest, common, all those good things, journal entries. So always start with cash. Well, in this transaction, it sounds like you're receiving cash. So I would debit cash. You're receiving that asset. However, generally, if you fulfilled your end of the bargain, you would credit revenue because that's how you increase revenue. But you didn't yet. You're going to. Takes time. Maybe totally reasonable. So you're going to now credit unearned revenues, which is a liability account. See, I noted on the balance sheet because you owe them the same value in cash as the service. What about when you fulfill the good or service? Well, we reverse it out and we debit unearned revenues to reduce the liability on the balance sheet and get rid of it to zero. And then we credit revenues. Now, if it's partially completed, obviously we'll use those partial numbers. That's fine. But this is under the assumption that the whole service is performed at this one date.